doing an event study the right way, or doing an event study to yield reliable results on the subject of examination. That means to find out the impact of a particular information flow on the market. Some issues are there which the researcher needs to kind of understand, and also the researcher needs to be aware of the possible ways of kind of addressing these key issues in doing reliable event studies. So we'll spell them out here in this part of this discussion, and after that we'll proceed with the discussion of a practical case based on the nitrate incident, and also use the data set that we have used in our research, more specifically PhD research, and which got published in the Journal of Australasian Accounting, Business and Finance Journal. I tend to remember, I tend to forget the name, which is a B category journal if you go by the VDC ranking. So this data set that we use for this research, I will use that to highlight or kind of give you a practical guide as to how an event study can be executed. Now, the first issue that we have when it comes to doing reliable event studies is to appreciate the fact that news can have sentiments. What it means? It means whenever there is a news flow, event studies should take into account that the news flow can be positive or negative. And when analyzing the impact of the information on the market, more specifically in terms of price and volume reaction, one needs to isolate these events into two broad categories: positive events and negative events. So let me use an example to emphasize on this point. So Sprenger and Welp in their study, if I can kind of give you the perspective, Sprenger and Welp in their paper, they highlighted this fact, and this fact was also kind of observed in the paper that we have kind of come up with. As I mentioned, like in 2018 we came up with a paper using event study literature, which was published in a Scopus in Web Science Index Journal, the Scientific Annals of Economics and Business. So this particular fact was emphasized by Sprenger in their work. Now, this particular aspect of doing reliable event studies is concerned with the sentiment of the news flow. What it means? Now, if there is a news flow, suppose we are trying to understand the impact of earnings news on stock prices. So if we deal with earnings news flow without considering the sentiment of the news flow, that means whether the news flow has a positive tone or negative tone. So what is a news flow with a positive tone? If we go by the work of Pritamani and Singhal, it is basically the direction of the price movement. So if there is a positive news flow, typically it will be associated with a positive price movement. That means there will be an increase in stock prices. And if it is a negative news flow, typically it will be associated with a negative or a decrease in stock prices. So the direction of the price movement will indicate the sentiment of the news flow. So when you talk of earnings news, we can have good news and bad news. Like if the earnings increase maybe quarter on quarter, year on year, we can say the news is positive, or it satisfies the market expectation with regard to the earnings numbers. We can say the news is positive. But if somehow the earnings are, so to say, below the expected performance, or it has not been able to grow year on year or quarter on quarter, we can say the news is negative. So in that case, the reaction, associated with such news flows can be typically found to be negative. Now, if the researcher does not take into account the positive and negative sentiment of the news flow, typically what is witnessed, as was the case with the research they have done, Sprenger and others, and they observed that at the aggregate level, when the sentiment was not taken into account, the market reaction was not found to be significant even on the event day, which is typically associated with the strongest market reaction. On the other days, these returns were significant, but only at the 10% level, and that too only in case of certain kinds of events. So they consider these results to be spurious. But what they did in the next level of their analysis, in the same paper, they took into account the sentiment of the news flow, and what they did, the resulting, because out of 6, they took into account the sentiment. So we had 6 categories of positive and 6 categories of negative events. So among the resulting 12 event types, 11 were associated with statistically significant returns on the event day. So what is the key point here? The key point here is, whenever you do an event study, please take into account the sentiment of the news flow. So there are different approaches to taking into account the sentiment of the news flow. One can use machine learning, computational linguistic methods for doing it. That is a more sophisticated way of doing it. But if for a layman or somebody who is trying to kind of come up with a research which does not involve machine learning for that matter, can use the approach adopted in Sprenger and Well, Bhattacharjee and they, obviously the paper we have published, guided by the work of Pitamani and Singhal, which was published in the Journal of Banking and Finance, which is again a reputed journal, where they basically classified their events into positive events and negative events based on the direction of the price movements observed on the event day. So that can be a simple but effective way of dealing with the issue of news sentiments. So first note, take into account news sentiment. Second, you can simply take the direction of the price movement on the event day as your guide to deciding the sentiment of the news flow. Then one is to understand the limitations of working with a specific priority in an event study. So what is a specific priority? What this actually means? There are some, or a majority of the literature that we have in kind of the academic journals with regard to event studies is concerned with examining the impact of a specific news flow. Now, while this approach is needed when you are trying to understand the impact of a specific type of news flow on the market reaction, but essentially one has to understand that when you are adopting this particular approach where you decide that specific priority means deciding in advance that I will perhaps concentrate or examine earnings news only. So what you are trying, or what you are actually compromising, or what you are actually ignoring is during that particular time frame, or during that particular event window, or during that time when this particular earnings news came into the market, which potentially led to a market reaction. There are different other kinds of news flows associated with this earning news, or kind of simultaneously they occur with these earnings news, which potentially might have an impact on the, so to say, stock prices. Now, what it means? Suppose if we talk of earnings news, typically they are associated with news flows regarding dividend payments, or news flows regarding compensation of the management. So if we have news flows which are primarily not related to the topic of our interest, which is earnings news, or news flow of our interest, which is earning news, we are actually ignoring the fact that potentially we might see the market reaction associated with that particular news flow, earnings news, but that news flow, earnings news might be accompanied by some other news flow which potentially might have an impact on the stock prices. Or more specifically, we are actually ignoring the information, the entire information environment of that particular stock, or the environment in which the stock prices of that particular stock, so to say, evolve. So one has to understand that one has to decide, when one decides as to what would be the nature or what would be the type of event that one studies in the event study, one has to understand that if we go by a specific priority, that means we decide in advance some specific type of news flow we want to study, we are actually essentially ignoring the other types of news flows that might potentially influence the evaluation of the firm. The other approach to doing such event studies is to not have any limitation, which was the approach adopted firstly by Ryan and Tuffler, where they did not work with any specific priority, but rather what they did is, they identified major price movements and then associated these price movements with news flows which can be of different categories, like earnings news. There can be some news flows regarding restructuring. There can be some news flows regarding the management. There can be some news flows regarding to the broad category called finance. So, they did not have any specific priority. So they decided to work with a broad range of, news flows, which typically can have an impact on prices. So this was also the, study or the motivation for the PhD work that we have done. Like in our study also, we did not have any specific priority, primarily guided by the fact that there is only, limited literature available, which does not have a specific priority in, taking up an event study, and they deal with all kinds of news flows, broadly categorized into, so to say, different broad news categories. So in our study, we had these guided by literature. Obviously, we had these 8 broad categories. So these are the two, approaches to doing an event study. You choose a particular event which you want to study, or you go with all sorts of news flows which you broadly categorize into different, broad categories. I must emphasize that the event study literature is so rich that, but at the same time, the number of studies available where there is no specific priority is very limited. But you have a wide range or numerous studies available where, they have tried to work with a specific type of news flows. So if you think of taking up event studies for any specific, research, like you are in the early days of your PhD research, then perhaps you can take up, an event study with no specific priority. That means you are trying to explore how market reacts to news flows of different nature. In specific, settings, like our work was primarily concerned with India, because in case of India, we had no prior study before to us. We already have published 3 papers on this, and the 4th one is still in the process of review. But our work basically highlights the fact that the literature available where no specific priority was taken is limited, and future studies can actually come up, with work concentrated around different kinds of news flows to give much more evidence on the subject of how market reacts to news flows in different settings. In case of all emerging markets, you can take up. So this can be food for thought for research in future. The essential issue of confounding events, which typically is, as I mentioned, when there is a news flow. Say the same example again, like if you are working with earnings news and we want to find out the impact of earnings news, and we ignore that there might be potentially other types of news flows accompanied along with this earnings news, like dividend payments, CEO compensation, then this gives rise to the issue of what we call confounding events in event studies. So if I go to the next slide, for example, this example is taken from the data set we have used in our research work. Like, for this particular stock, Bharti Airtel, basically Airtel, on a given day, 20th of July 2016, there were 2 news stories that we observed in our news source. First, Bharti Q1 beats estimates, profit up 11%, Africa revenue down 3%. So this is essentially what we refer to as, the earnings news category in our study. The other news flow was Airtel proposes rupees 30 crore annual package to Sunil Mittal, which is basically, it can be classified into the category management. Now, these news flows occurring at the same time, simultaneously on the same day, about the same company, but basically categorized into 2 broad groups, is the issue of confounding events. I must say that in literature, the issue of confounding events has not been addressed. There is no study which has, basically given us a approach to addressing the issue of confounding events. But one typical way of, addressing this issue is to ignore, those events where it was accompanied by other news flows. So what is the answer? If we observe a confounding event, suppose we are trying to study the impact of earnings news on stock prices, we see that for some specific companies on the day of the news release of earnings or earnings related numbers, we have some other news flow which typically does not fall into this category, earnings. We have to ignore them in our sample. So this issue of confounding events is very severe. Now, to emphasize on this point, I'll just give you the example in our research. In our data set of 2,867 news events, so whatever data set we uniquely came up with, unique because we had to develop this data set on our own because it is not available in the public domain. So we had to develop this data set. That means we observed news flows for all the stocks that are part of our sample for a period of 3 months. So After we have done the, so to say, the classification of these news flows, we came up with 2,867 news events, which can be classified into 8 broad categories. Now, when we check for confounding events, that means we check if there is some other news flow of a different category, before the day of the news release. We saw that, there were 1,809 instances of confounding events. Now, this is a very important implication when we choose the, so to say, event window for our study. Now, again, continuing this discussion, checking for confounding events one day after each news release, we find 1,806 cases of confounding events. So it is evident that any further inclusion of pre-event and post-event days in our analysis would bring more instances of confounding events. Now, it is quite interesting to note that literature largely ignores the presence of confounding events while choosing their event window and reporting the results. Only a few studies, I can name them, like Rand and Tefler, Newerell and Sprenger have ignored the issue of, confounding events. The studies which are, reported, which have been published in reputed journals, even they have ignored the issue of confounding events. But only this study done by Antler and Frank back in 2006, we have accounted for the issue of confounding events while reporting the results of the study. So a reading of this paper will help you to understand, and even the work that we have published so far, we specifically address this issue of confounding events, that it is very important when we are trying to assess the impact of news information on stock prices or trading volume, or for that matter, we are trying to assess the market reaction to a particular kind of news flows. It is important to take into account whether it is accompanied by news flows of other categories or other types, because if you don't do, we are potentially, so to say, impacted by the issue of confounding events, and our results might be actually biased. And we see from this particular discussion that if we increase one day before the event, if our event window is, say, the day of the event and one day before the event, in our data set, we actually lose 109 cases out of these 2,867 events. So increasing one day before the event actually led to loss of almost your 60-70% of your data set. Now, if we take the case of one day after the news release, we actually again lost almost 60-70% of the data set. So typically you have event studies with much larger event windows, 7 days, 15 days, 20 days, even like 30 days. So if we increase the length of the event window in event studies, typically you will be impacted by the issue of confounding events. So the key point to be noted here is when you choose the event window for your study, keep in mind confounding events can make your results biased. And if you do not account for them, your results will potentially be biased. So, increasing number of days in the event window can have the cost of what we call confounding events in event studies. So, shorter the event window, the more reliable your results will be. That is the key take. This has been emphasized by the work of Brown and Warner, where they have specifically recommended short event windows reduces the chance of having confounding events and increase the reliability and validity of event studies. Further, it may be noted, as observed by McWilliams and Siegel, it becomes difficult for the researchers to control for confounding events as the event window gets longer. So as one would understand, if you increase the length of the event window, you will have this issue of confounding events popping up every now and then. Working with longer event windows in the analysis of daily data potentially or typically can lead to confounding events and distort the results of the study. So Brown and Warner says our study also observes, Sprenger will emphasizes the, Antler and Frank also emphasizes this, that go with shorter windows if you're working with daily data to come up with more reliable inferences about the nature of market reaction associated with the particular news flow that perhaps you are interested in. Then we touch upon the issue of choice of the news source. Like as I said, in an event study, we are trying to understand the impact of a particular information flow on the stock prices and trading volume. Now, the first key issue here, apart from deciding what kind of event we are trying to understand, whether we are going to work with a specific priori or we work with multiple events at the same time, we need to decide on the news source. Now, when I say news source, typically in literature, if I can go back to that slide, there is no uniformity. Like and depending on the purpose of the study and the context of the country in which it was done, the study was done, news sources typically used by researchers, traditional sources like Dow Jones, News Service, Wall Street Journal has been used in literature. Again, unconventional news sources like Twitter, internet stock message boards have been also taken into account to take into account modern day realities. Because as you understand, nobody reads newspaper or solely relies on newspapers to get access to information which might have a potential implication on the stocks they hold. Rather, this Twitter, these internet stock message boards, like in Money Control, we have these discussion boards where they where investors continuously share messages or the information available with them with other investors. Some of them might be true, some of them might not be true, but this also potentially is a source of information for the investor and which might actually yield market reaction. So the choice of the news source done by the researcher should be done in the context of the country for which the research is undertaken. Now, with regard to the choice of the news source, obviously a reading of our papers can elaborate on the choice of the news source which we use for our study, Money Control for that matter, and why we have used it. But there is a practical guide to adopting or choosing the right news source. Sprenger and Well mentioned that the news source that we choose for the purpose of our study should reflect news flows from an investor's perspective. And more specifically, it should capture news flows with timestamp. That means the news flow should be timestamp. What is timestamp? So suppose if you have a news article in your news source where they mention the date and time of the news flow. So that way it is called timestamp. So choose a news source which helps you to accurately identify the timing of the news flow. So that is the key message. So whenever you choose a news source for your study, event study, more specifically, you choose a news source which gives you time-stamped news flows. So this point was also emphasized in the work of Brown and Norton 1980, where they recommended that the most important aspect of an event study is to identify the timing of that event. So that can be only done if your news source is providing you time-stamped news flows. Then the next aspect in doing a event study the right way is the choice of the sample period. Now, whatever sample period we choose should be free of a significant market-wide event. So suppose you are trying to understand the impact of earnings announcement in the case of Indian stock market, and you choose your sample period which includes the period say from March 2020 to say June 2020. You observe your stocks for a period of 3 months. So whatever news flows are there for your sample companies during these 3 months, you use that data to draw reliable inferences with regard to the nature of the market reaction when there is an earnings news. But you potentially must note that this was the period when the COVID outbreak was there and the lockdown was there and all the issues, the stock market crash was there. So whenever companies were reporting their numbers, it was, so to say, kind of under the influence of the developments or daily developments with regard to COVID-19, how the pandemic evolved. So the news flow potentially, the earnings news flow potentially was influenced, or a much larger influence was there with regard to the developments of the daily, COVID data or number of infections or deaths. So your sample period should ideally be devoid of such, kind of large magnitude events, or should be a fairly stable period, so that you can draw reliable inferences about the information flow that you are, trying to study. Obviously, of course, it is otherwise. Like you want to study the impact of, your information flows on the market when the COVID-19, took place. So that way it is justified. But if it is not the case, you are trying to understand the general understanding, or you are trying to develop a general understanding of how, earnings news impact the markets, then if you choose the COVID-19 period, potentially your results might be biased. Now, having said that, the next or the important aspect that one has to consider is the choice of the sample and the issue of what is, whenever we choose the sample for our study, that means the suppose we want to understand the impact of, again, the same thing, like earnings news and how it impacts stock prices. The sample in our study is, say, Nifty 500. So as we understand, Nifty 500 is basically the top 500 companies in our, in the listed on the NSE in terms of market capitalization. Now, in this top 500 companies, obviously we have, if you go by the size, we have large companies, we have medium-sized companies, and we have obviously small companies. If we use the traditional or kind of more popular nomenclature, we call them as large caps, mid caps, and small caps. Now, if we use such a sample, this issue was actually identified by the work of Barnes, 1981, where they observed that associated with small size company is much larger than large cap or large size company. So this also we relate at a more kind of general understanding. We understand that small companies or small cap companies can give you much higher returns if the nature of the news flows in that particular stock is positive. So the movement that we associate with that news flow might be on the smaller side, because the magnitude of the price movement is function of size. So that is what is emphasized in the work of Barnes, 1981, and they refer to it as size effect. So what is the potential solution to this issue? That means if you choose a sample for your study, try to choose a sample which typically follows a particular group. For example, if you are working with earnings news, choose companies which basically can be clubbed into the same bracket. Suppose you work with Nifty 50. So essentially you address the issue of size effect. That means your stocks are primarily large cap companies. So if you include mid cap companies, so maybe you can work with Nifty mid cap. If you want to work with small cap companies, so maybe you can work with small cap, Nifty small cap. So if you are doing an event study, always keep in mind the size, the issue of size effect, or more specifically the constitution of your sample. If you have diverse companies belonging to different size groups, then you must actually take that account while spelling out your results or providing your results. So if you do an aggregate analysis, perhaps you should break that analysis and see if the nature of the reaction is different in different size groups. So that can be done. Next, we take up the issue of the calculation of returns. So when you say stock returns, how exactly we calculate it? Typically, we use logarithmic returns. So why we use log? The answer to this is basically the study by McKinley and Campbell observed that potential problem of non-normality of return data is avoided by assuming that returns are log normally distributed in implementing the regression model on log returns. That means you are calculating your returns using the log transformation. So that is typically done to address the issue of non-normality of return data that we typically observe in time series data of stock returns or price data or volume data. Corrado and Trong pointed out that logarithmic returns provide better specification of statistical test than tests based on just arithmetic returns. So how logarithmic returns can be used or calculated, I will show you when I take this practical case for our study or reference. Apart from that, the choice of the market model. That means with regard to the choice of the normal return generating model, we saw that we have different approaches or different models are available at our disposal. But which model to use? The literature has suggested that one can go with the market model. Now, what is the market model? Obviously, and why we employ the market model? Typically, it is guided by the studies by Brenner, Armitage, McKinley, where they observe that the market model is widely used in literature in event studies. Brown and Arner, McKinley, and Binder show that market model performs well under a variety of conditions. Armitage emphasized that sophisticated models add very little to the performance than the market model. That means if you use a different sophisticated model, the normal returns that you estimate may not be any different from the estimation provided by market model. So sophistication does not necessarily mean better results. Brown and Horner in their classic study concluded that none of the more sophisticated risk adjustment techniques estimate the abnormal return to estimate the abnormal return improved upon the simple market model. So the simple market model works well under a variety of conditions, as the evidence has been documented in literature. So which model to choose? The answer is market model. And why we choose them? We have the literature at our disposal. Okay, now the other important issue is the issue of what we call time interval. Like that means, which kind of data we use, whether we go with intraday data, whether we go with daily data, whether we go with weekly data, or any other type of data, maybe monthly data. The answer to this question is basically, if you go by the work of Campbell, McKinley, and Kothari and Warner, they emphasize that the use of daily data can facilitate precise identification of event dates. So you know when exactly the event or when exactly the information flow occurred in the public domain, and consequently lead to more precise estimation of the impact of the event. So what is the takeaway from this? The takeaway is, if you are doing an event study, try to work with daily data. And lastly, the issue of estimation window, like what window or what is the length of the window we need to choose when we are trying to estimate the parameters of the normal return generating models. So a detailed discussion can be found in the work of Dickman with the work which was published in the year 1984, and if I'm not wrong, that work was published in the very prestigious Journal of Accounting Research. And obviously our work is published in Scientific Annals of Economics and Business. So the estimation window that the researcher can choose for his or her study, again, there is no uniformity in literature. Some studies have used 120 days for the estimation window. Some studies have gone with 200 days, and you can have a wide range of number of days with regard to the choice of the estimation window. But the answer which is the optimum, or which is the kind of more efficient estimation window, the answer to this question was perhaps given by Dickman way back in 1984, where they compared the performance of event study methodologies using daily data and using different estimation windows. And they observed that a 120 days estimation window, and where the normal return generating model is the market model, may be preferred over other combinations. The authors caution that the results of the study may be influenced by the choice of other estimation windows. So the choice of the estimation window is very critical. So in the context of the observation, one may use 120 days estimation window for their study. But I must emphasize here that whenever you are doing an event study, try to find out the related literature. So if you are studying earnings news and its impact on stock market, so try to find out related studies maybe done in the context of India, where they have explored this particular dimension of news flow, and see what is the length of their estimation window. Why? Because typically the length of the estimation window will influence the results of the study. And if you are to compare your results with their work, then obviously if your estimation window is same, then your results become comparable. If they are not, then you have to draw conclusions accordingly, or with caution, I must emphasize. So the answer to this question, what is the length of estimation window a researcher may go by? Literature suggests 120 days, market model, it works fine. But if you are dealing with a specific type of news flow, keeping an eye on the existing related literature will do a lot of good in terms of achieving the comparability of the results with the existing studies, which obviously every researcher needs to do. Draw conclusions based on existing evidence and what evidence you come up with. So these are the key issues one must keep in mind when it comes to executing event studies. So we have tried to provide the answers to all these key issues with regard to conducting event studies the right way. For example, news sentiments must be kept in mind, how they are to be done. One can go by the direction of the event day price reaction. One has to decide whether one goes with one kind of a particular news flow, or multiple or different kinds of news flows together simultaneously, specific priority or with no specific priority. One needs to keep in mind the issue of confounding events and the potential implications on event window. Choice of the event window. What news source to choose typically should be guided whether the news source provides me time-stamped news for the purpose of my study. Choice of the sample period should be devoured on any economy-wide or major event. When I choose the sample for the study, I have to keep in mind the issue of size effect. If I have multiple companies which can be classified broadly into maybe large cap, small cap, mid cap, then I have to split my evidence accordingly to come up with evidence whether the results would change if we take into consideration the size effect. Then we obviously, when you calculate the returns, we typically go and calculate with the logarithmic returns because they provide better reliability with regard to statistical tests, and also the issue of non-normality can be addressed. The normal return generating model typically is the market model. Time interval prefer daily data over any other kind of data in an event study. Estimation window, typically it can be 120 days along with the market model for coming up with reliable conclusions with regard to the event studies. So these are the key issues in event studies, and we have tried to come up with, so to say, some practical guide, or so to say some approaches that we can adopt for doing reliable event studies guided by extant literature available on the subject. In the next part of our discussion, we would move to a case study to understand how an event study can be executed. First, we'll use this Deepak nitrate thing to see if there is any market reaction, and more specifically how an event study can be conducted, and how the aggregation can be done to come up with the conclusive results. Because as you understand, as we have spelled out, one event for a single firm will not give you the right kind of evidence or the right kind of impression with regard to the nature of the news flow and the impact it has on the market. So you need to observe multiple events at the same time and see how it impacts maybe stocks or the market as a whole on multiple times, and then come up with your aggregate findings. So that is the approach one needs to adopt. So first we will see how a event study can be executed using this Deepak nitrate thing, and then using the data set we'll see how the aggregation can be done. So we'll pause here just to make sure that if we have any questions with regard to the discussions that we have taken up so far. Yeah, I can see a couple of questions. One is how to identify confounding events. Madam, the point is you have to check if the first thing, the idea of confounding events. The idea is you are trying to observe impact of market correction or the impact of earnings news on stock prices. But that earnings news is also accompanied by some other category of news flows, which is typically not related to your earnings numbers or the information with regarding to the accounting numbers of the business or the operational performance of the business. So that is a case of a confounding event, where your event of interest is accompanied by some other event which is not of your interest, or which you have to appreciate that this event that you are trying to study is also accompanied by that event. But how will you understand that how much of the stock price movement is because of earnings news and how much of the stock price movement is because of the other news categories, right? So this is the issue of confounding events. Now please tell me if that understanding is okay with us. What is confounding event? Okay, now how do I identify it? That is the question you are trying to understand. I basically see in my news source if that particular event is accompanied by some other news flow, maybe of a different type. So as I gave the example of this particular case of Bharti Airtel, on the same day, 20th of July, if I take you back to this particular slide, on the same day, 20th of July, we have two news flows for Bharti Airtel in our news source, Money Control. What is that? If I, we have two news flows. The first one is about the earnings numbers. Bharti Q1 beat estimates. So the profit was up by 11%. The African revenue was done by 3%. So that was basically related to the earnings numbers. But on the same day, we had another news flow where Airtel has kind of, the board has passed a annual package of 30 crore for the CEO, Mr. Sunil Mittal. So essentially, these two types of news flows are, belonging to two different event categories. The first the one is related to what we call the earnings news category, and the other is related to what we call the management news categories. Now, if there's a price movement in Bharti Airtel on that particular day, how do I know which part of the price movement or what proportion of the price movement is because of earnings and what proportion of the price movement is because of the management news? So I have to look in my news source if the news flow that I'm trying to study is accompanied by some other news flow of a different category. So that is the only way. So you have to identify or choose a news source and identify in your news source if that particular news flow is accompanied by some other news flow of a different category. So that is the way you identify confounding events. Am I able to address it now, the question you have? Okay, thank you. I have another question. Sir, don't call me sir because, I presume you and me all are, learners. So we are all here to kind of, discuss a beautiful idea of event study, which one can use for understanding how market reacts to news flows. I'm just sharing what I have learned over this past couple of years so that, more research can be taken up in this area, perhaps in collaboration as well. So the whole point is, let us try to kind of see that the event studies can be very effective in understanding how market reacts to news flows of varied categories. Now we have a question here, like what are the hindrances you think we should be aware of when we do event studies in a volatile market like cryptocurrencies? See, the point is, when you talk of cryptocurrencies, yes, event studies have been using cryptocurrencies, but when we talk of something like cryptocurrencies, which basically the price movements, the literature is not decided whether news flows impact your price movements. They have obviously some evidence where they have tried to suggest that news flows perhaps impact your cryptocurrency returns, but typically what kind of news flows? Because in stocks we can understand we have these earnings news flows, we have some information related to maybe some restructuring of the business, we might have information related to some financing decisions that the management has taken, some CEO joining in or somebody resigning. So we have wide range of information that actually flows typically in the case of equity markets. But for cryptocurrencies, the question that we need to answer here is not what kind of information, but whether information drives cryptocurrency prices. That is something we need to understand. And obviously, cryptocurrencies as a area of research is evolving, and some research has been undertaken to kind of find out the linkage between information flows and cryptocurrency returns. But typically, you must understand that cryptocurrency prices, the question essentially is to find out if information per se drives cryptocurrency returns rather than the nature of information flow. So that is something we need to kind of appreciate before we proceed our event studies. Yes, you can kind of keep the same things in mind when you are doing an event study, maybe with cryptocurrency returns or for that matter any asset return that we have typically highlighted in this discussion. But essentially, which kinds of events you will choose, that you have to kind of spare a lot of thought, because that will dictate as to the relevance of your study. I hope yes, I can see the answer. So a very pertinent question, and I am very happy that you are actually extending this discussion to explore beyond equity markets, which typically was the focus in case of our study. So let us use the remaining part of this session. We typically I have about a half an hour to go for this session, and I believe the rest of this discussion will be towards this practical case study that we use for developing our understanding how an event study can be executed. Just to revisit the key ideas, practical guide. This is the first slide. So we have 8 slides here. So the first slide is how do I measure abnormal return? The key concept, abnormal return, I can use this equation to kind of define it. Abnormal return is nothing but the difference between abnormal is the actual return on abnormal return for a given firm on a given day, firm I at time t, is nothing but the difference between the actual return for farm I on day t, that means whatever return we have observed, and the expected return, which I calculate using the return generating model in the absence of the event. So that is the difference. So the other idea, what model I can use for calculating the return generating model? It is the market model. It is represented by the equation as spelled out here. So the market model can be denoted by expected return for a farm I at time t is given by the alpha coefficient plus the beta coefficient, and it is nothing but the slope of the OLS regression that we run on the market return, that is the portfolio return, maybe Sensex if we take the case of India, or maybe a broad-based index like Nifty 500 or BSE 500, S&P 500, and then the error term. After that, the price reaction to arrival of different corporate news is studied by aggregating the abnormal returns across all the firms experiencing the event. Now, how do I aggregate it? I find out the average abnormal return. How do I do it? I add all the abnormal returns for all the firms that are there in the sample for which the event has been observed, and divide it by the number of events that is there in my sample. What do I do to test the statistical significance? I use cross-sectional t-test. Now, statistical testing is something very important. Like when it comes to literature, we have a wide range of statistical tests which we can use for the purpose of our event study, or to kind of accept or reject the hypothesis that we have for the event study that we are conducting. Now, broadly, we have this parametric and non-parametric tests like the rank test, the sign test, which you can take up or which you can use for finding out the validity of our hypothesis, or the accept or reject. That is basically hypothesis testing. But which test to use among this wide range of options? That is the thing we need to understand. Literature has suggested that one can go with the cross-sectional test. So this evidence or this suggestion was first provided by Brown and Warner, who recommended the use of parametric test for significance testing based on the standard errors from the cross-section of the event window abnormal return. Now, how we do it, obviously I will explain to the case study. In addition, Dickeyman has also suggested that the t-test provide more accurate results with regard to abnormal performance despite the non-normality of daily data. In a recent study, De Jong and Nobuska recommends the use of cross-sectional t-test as suggested by Brown and Warner for significance testing. Recent studies by Antler and Frank, Sprenger and Well, URL, they also employed the parametric t-test. URL in their study have also used the sign test, but they observed that the non-parametric test seem to have lesser power than the parametric test, which is the t-test, cross-sectional t-test to be more precise. We may employ the cross-sectional. The answer is one, while doing significance testing in case of an event study, can go with the cross-sectional t-test. One has to perform a two-tailed test because price and volume movements can occur in both directions. That means positive as well as negative. That is the whole point. Cross-sectional t-test, perhaps one can go with. For more, robustness, one can also employ parametric sign and rank test, but typically you will see that whatever results you have obtained through the cross-sectional t-test are also corroborated by the sign and the rank test. That means the same results you will obtain. So the suggestion is go with cross-sectional t-test. If you want, you can go with parametric test as well, go with sign and rank in that case. Okay, so how this cross-sectional t-test can be done? It is basically represented by the equation as given here, where T is the test statistic, AR, the numerator is basically the average and in the data set, divided by the standard error of this abnormal returns in the event window across all n observations for a given, how that can be done. Now, This particular thing, the first thing, this is taken from the research paper that has been accepted for publication in this particular journal named the Australasian Accounting. Summarizes the kind of reaction that you observe on the day of the event. If we talk of the news flows at the aggregate level, so we have this positive reaction. So
हाँ तुम्हारा आ नहीं गया लास्ट मतलब कि 3-4 मिनट पहले से तो रिएक्शन देंगे पॉजिटिव रिएक्शन नेगेटिव रिएक्शन वो जो स्लाइड अभी जो दिखाया था ना वो पॉजिटिव रिएक्शन नेगेटिव रिएक्शन प्री मार्केट प्री इवेंट डेट और अभी कनेक्ट हो जाओ पहले हाँ अब आया एक बार शेयर करो तो पता चलेगा
yeah, we lost connectivity in between. I was somehow not aware. I was kind of caught up with the session itself.
This was the last slide you were discussing.
This was the last slide. Okay.
Yeah.
What I'll do, I'll again kind of start upon it. So what we have here is basically the type of reaction we have observed in the research paper that we have come up. What we need to understand from this particular slide is the type of reaction with regard to the patterns, under reaction, overreaction that we have witnessed for the Indian markets with the sample of our study. So what we observe, for example, if we take the case of the positive news events. So on the day of the news release, this event day reaction was positive, statistically significant. But if you look at the pre-event day reaction, it is positive but not statistically significant. So pre-event day reaction would suggest if there is any information leakage in the market. So we cannot conclude if there is a case of information leakage in the Indian markets with regard to positive news flows at the aggregate level. Now, with regard to the nature of the reaction, with regard to underreaction or overreaction, so what we see on the event day, there is a positive, price reaction, but on the succeeding day, that means the post-event day, there is a negative price reaction, but apparently this is not statistically significant. So the interpretation is there is some indication of what you can call is overreaction. Please note, overreaction is, reversal of the initial price reaction. So the initial price reaction is positive. On the next day, we see a negative reaction. So perhaps markets overreact to positive news. But again, because the succeeding day news flow or the news or the price reaction is not statistically significant, so one needs to gather more evidence. But preliminary, suggestion one can, or preliminary inference one can draw is that perhaps some suggestion or some indication of overreaction to positive news flows. But if we look at the case of negative news, what we see on the day of the event, we have a negative kind of a news flow or a price reaction. One day before the event, the direction of the price reaction observed is positive. So what it indicates? Perhaps market had no clue that on the succeeding day there is going to be a negative news flow. So perhaps no information or no evidence of or not trace of information leakage. But if we look at the post-event day price reaction, what we observe is the direction of the price movement is opposite. That means again, this is what we call the markets have perhaps overreacted to the negative news flow, and again that's why we see a so to say recovery on the succeeding day. So the preliminary evidence as observed in our study is markets perhaps overreact to news flows. So that is something I would like to highlight, and perhaps this can be taken up for research further as well, whether this overreaction is true for a different sample, maybe with a much larger data set, as is the case with our example or in our study. So we have some evidence of overreaction to news flows in the case of Indian market. So quickly let us go, because we have around 15 minutes to go for this session. Quickly let us go for this case study that we have in store. So how do I do an event study? That is the question. So I need data. I need data. What I need, first I need to choose a market portfolio. For the purpose, we have a more inclusive market portfolio. For example, Nifty 500. Because if we choose something like Sensex or Nifty 50, we are only talking of large cap companies. But Deepak Nitrate essentially is not a part of large cap companies. So comparing the performance of Deepak Nitrate with perhaps a index which represents large cap companies is not the right thing to do. So literature has suggested that one needs to come up with a more broad-based index which is more inclusive. So Nifty 500 can be a case if we talk of the Indian markets. If we talk of, for example, the US markets, one can go with S&P 500, absolutely fine. So what we need to have? We need to have the daily data for the reference portfolio, which is Nifty 500 in our case, and Deepak Nitrate, because you want to investigate whether the fire actually had an impact on the markets and what was the nature of that impact. So what we have essentially the data. So this data we have downloaded from the NSE website. As you know, typically we'll have the open, high, low, close numbers or the prices for this is for obviously Nifty 500, and this is for the stock. I have brought them together. The raw files look a little different, but I have brought them together, the same data that is there in the raw files, and I have calculated the index returns, Nifty 500 returns, and Deepak Nitrate return based on the closing prices. So how do I do it? Log transformation I have done, today's close divided by the previous close. So that is how I do it. So if I just show you, how do I find out the return for Nifty 500 on 15th of June? I refer to the close price and I divide it by the previous close price. So that gives me the return for Nifty 500 on 15th of June. I can repeat this process. I get the returns essentially for the rest of the days for Nifty 500 and as well Deepak Nitrate as well. Now, once I have these returns, now what I've done, I have lined up the returns in one place so that it becomes easier for us to kind of relate and concentrate on the purpose of our discussion. So what I have done, once I have these two returns, I can simply run an ordinary least square regression to find out the coefficient estimates. That means my alpha, my beta for the regression equation. But I must emphasize that when we talk about event studies, typically the alpha is ignored. This discussion, detailed discussion, can be had or can be found in the work of Ryan and Tefler. Why this alpha can be ignored? Because it is not of much importance. But having said that, what is of essence is finding out the beta. So what we do, we simply use the slope equation in the Excel to find out. We can use the SPSS also, or we can use EViews also to run this OLS regression. The results would essentially be the same. But the slope function gives me the estimate for beta for this particular stock, Deepak Nitrate, with reference to the market portfolio Nifty 500 in this case, which is 1.46. if we can conclude that way. So if I have this, I can calculate the abnormal return for on all the days in our so to say period of study. Now when I look at the period of study, now how do I calculate the abnormal return? Let me kind of introduce. It is nothing but actual return, which is basically x2 minus your nifty return on that given day multiplied by your beta. So that is all you need to find out your abnormal return. So how do I do it? I will again kind of show you. I need the actual return, I need the beta, I need the market return. So I convert it in percentage, essentially the same thing. So this is how I find the abnormal return for a given stock on a given day. I do this for all the days in our period of study. Now, this is something we need to kind of relate. Now, how do I find out when the information flow actually occurred? For this particular case, the safest thing to do is to go to the NSE website and look at the corporate disclosures that Deepak Nitrate has done. So you will have the date and time stamped. So if you open this, general updates, you will find that there is some information flow with regard to the fire incident. So this is the notice that came in the evening of 2nd of June. So one would relate that if the information has come in the market or in the public domain in the evening, the markets are not open then. So this reaction you will observe on the next day. So what we see on 2nd of June, Deepak Nitrate, actually there was a positive price movement, 1.63. But on the succeeding days, 3rd of June, the stock prices fell almost 4%, 4.38% to be precise. So this is because of the fact that the fire breakout incident happened on 2nd of June and the exchange filing was done at 10:30 in the evening. So naturally the reaction you will see in the succeeding day, that is on 3rd of June. So there was a 4% fall in the, so to say, stock prices. Now, the point is, on 6th of June, 4th and 5th, 4th, 5th were holidays. So 6th of June, you see again, the sign of the price reaction to be negative. The negative, reaction continues. There is one more additional, information here. There is some reports in newspapers where Gujarat government has issued some closure notice. It was reported, and there was an exchange filing regarding that in the evening. The clarification was sought by the stock exchanges whether this information is true. On 9th of June, by afternoon, they had this clarification where they said like the investigation is going on. As of now, they have not received the closure notice, but they are cooperating with agencies. But on 10th of June, after this clarification come, there was a positive, price movement. So the stock prices recovered because of this, so to say, because they did not confirm that the closure notices come. But to be more precise, by the evening of 10th of June, 4:39 to be precise, it was confirmed that that particular plant has been ordered to be closed by the Gujarat government. Now, how do I know if this price reaction that we see on the day of the news release is so to say correct, or so to say there is a market reaction, or this market reaction is significant. So what we do, the same thing, we have the actual return, and from there we need the beta, and I multiply the portfolio return. So we see that the abnormal performance on 3rd of June for Deepak Nitrate is minus 0.33. So they delivered a lower return than what was actually expected. So I'll fix this using the dollar sign. So what we see, on 3rd of June, there was a significant market reaction because of this, fire incident that they reported the previous day. Statistically, T value is statistically significant, minus 13.74. So as you know, like if it is more than 2.57, then it is significant at the 1% level. Now, how do I calculate this? So what I do, I have this observation window of 120 days. So I can start my observation window one day before the event. So 3rd of June, observation window starts from 2nd of June and it goes back to 9th of December. So 120 days. 120 days. If you look at the count, it is 120. So using this, I calculate my standard deviation of these abnormal returns, because we are talking about the cross-sectional abnormal returns. And then I, typically the formula is I find out the square root of number of days in the event window, 120, and then I, find out the, what is the formula for t-test, like, average divided by sigma by root n. So I find out this part, sigma by root n, it is 0.002507. So the t-value, if I divide the abnormal return with the, this part of the equation, sigma by root n, we find the t-value is 13.74. So on the succeeding day also, we have a statistically significant reaction. 7th of June, we have a, some recovery, statistically significant. But again, because of this, in newspaper reports that Gujarat government has issued some closure notice, we see that, these stock prices have actually decreased further. And this declining trend continues. But again, on 10th of June, we have a very strong recovery in terms of abnormal performance, because they, in the evening or by the afternoon previous day, they had these reports that, actually they have so far not recovered any closure notice. The matter is still under investigation. So the markets have recovered. So what we see from this, first, markets react instantly to corporate news or news flows, as was the case with our evidence in the research paper. What we see, if the nature of the news flow is negative, we have a negative reaction, as we confirm here. What we see, the negative reaction is perhaps, an underreaction, because the negative reaction continued on the subsequent days. But after that, it's tried, it showed signs of recovery. But again, the trend has continued because some more bad news has come to this counter. So you will see that this initial news of fire breakout is compounded by these additional news flows, though it is related to the same category of news flow, but essentially this is a different news flow. So your momentum that we witness here is typically dictated by additional news flows into this counter related to the primary news flow, which is the fire breakout. So this is how a event study can be used or executed based on the framework that we have discussed in this session. Now, the point here we need to emphasize and understand is we cannot draw conclusions based on a single event for a single firm. We need to have a sample of events for multiple firms. So how do I use that evidence to kind of sum up, or how do I sum up that evidence to kind of come to conclusion? Suppose now I use the data set we have used in our paper. I have around 5 minutes to go, so I'll try to kind of sum up in the remaining time. So what we see, suppose I want to find out for the Indian markets, what is the impact of earnings news. So what we have for this entire sample, we had around 9167, which is the total count. Out of this, I am trying to, because some days we had no news, so total observation days was 9,176 for the data set we have used in our study for the paper and also for the PhD work. So we are typically trying to understand the impact of earnings news. So we are trying to find out in our sample all those companies which had this earnings news, and these are not confounded. That means there is no other news flow of any other kind, accompanying the news flow of our interest, which is earnings. So what we do for all these companies, we had Adani Enterprises, Ajanta Pharma, Ambuja, Arvind, all different companies, but the same type of news flows, earnings. We find out the abnormal performance on each of these event days. What do we do? Once I have, how do I find these abnormal returns? By the same methodology that I have discussed for this event study. So basically, each abnormal return here reflects one event study. So if we have 78 instances of earnings news flows, we have actually executed in principle 78 event studies for this particular study. Now, how do I aggregate these results of the 78 different event studies? and come to a conclusion whether earnings have a positive or negative news flows and whether they are statistically significant. What I do, because as I said, I'm trying to explore at the aggregate level. Yeah, any questions? Because I could really pop up. Okay, couple of questions I can see. I will kind of answer this. Okay, now what we are trying to understand, what do I do to aggregate these, single event studies that I do for each of these sample forms in our study. So for these 78 instances where we have calculated the event abnormal performance by the methodology you have discussed for Deepak nitrate, the case of Deepak nitrate, I copy these abnormal returns in a different place. I'm doing this so that you are able to relate how the process can be executed typically. So all these abnormal returns I am trying to bring together because I am trying to find out whether abnormal returns or whether earnings news has an impact on the market. So I will find out the average. That means average abnormal returns associated with earnings news across all firms in the sample. So the average returns is minus 0.082%. What is the average standard deviation? The standard deviation for this abnormal returns is this much. But as you have understand, we have to adjust this by the SQRT of 78 because there is a number of instances or number of events. So what I do, I divide the average performance with the cross-sectional standard deviation. I arrive at the p-value for this particular event. Now, what it means, the earnings news is found to have a positive, so to say, we associated market reaction with earnings news, and this is statistically significant only at the 10% level, because if it is below 1.96, we understand it has to be significant at 10% level. Now, if I again go back to this slide, you will see, not here. Okay, never mind. I have not really included that part, but never mind. We have what we need here. We can use this approach to, kind of do the aggregation we need to kind of arrive at the aggregate, reliable or aggregate evidence on the subject of our study. So what we observe here, we observe that for earnings news, we have a statistically significant reaction to earnings news in the case of Indian markets, but it is significant only at the 10% level. So how do I do the cross-sectional, t-test? I find the average return for the sample of events in our sample. Basically, we have 78 events for earnings news. For earnings news related events, we have 78 in total. I find the average abnormal return associated with all the earnings news in our data set. I find out the cross-sectional standard deviation. I divide the average return with the cross-sectional standard deviation to arrive at the p-value. So that will help me to conclude whether that particular type of news flow has some kind of, or invite some kind of market reaction based on that news flow. So this is how we typically use event studies for the purpose of understanding whether news flows have a impact on stock markets, or more specifically stock prices and volumes. So with this, I will formally end these sessions that I am supposed to kind of deliver. But I have two questions here. The first one is how to get such data? Is it pre-made from a database or manual interference was required? Okay. Now, when I'm coming to this answer, like for the purpose of our research, we had to manually do it. Like what we did, these 3 months, this sample is actually relating to 1st of July 2016 to 30th of September 2016. So during this period of 3 months, we observed all stocks included in Nifty 50, Nifty mid-cap 50 and small-cap 50. That means 150 companies were observed on a daily basis, and we manually referred to money control to collect all news flows relating to these sample companies to arrive at this data set which I have shown, this particular data set. So this is manually done. But researchers have also used certain APIs or computational linguistic methods where the news collection source was automated. But I must emphasize the classification part, like which news flow can be categorized into which type. Again, you can take the manual route, which have been adopted in prior studies like Ryan and Tuffler, published in the Journal of Business, Finance and Accounting. But again, you can use also computational linguistic methods where you have a training data set and you can use that to kind of classify your news sources without any manual intervention. So to sum up, we have two approaches. You do it manually, which is quite tedious, but you can also do it using computational linguistic methods, taking help of machine learning. But obviously, you need the right kind of skills to do it. But manual route is available to one and all. But that is again tedious because you need to create a database and make sure that your database is sufficient to cover all news flows. Because before we arrived at the conclusion that we'll use money control for our research, we had a pilot study where we observed 16 different types of news sources like Yahoo Finance, Google Finance, Business Standard, Financial Times, and we critically evaluated which news source serves the purpose that we want to actually achieve, which is like to get a news source where we have time-stamped news flows, like we exactly are able to identify the event dates or timing of the event, and more specifically it gives you information about the company with regard to all possible information flows. So that is something one needs to understand. Is it okay, the first question that you have asked, madam? Okay. Now let me kind of take up the second question before I take up the last question perhaps. Market also gets affected by the individual company news, or let's say Reliance, which is also part of Nifty, get affected by some negative news. Because of it, Nifty also get affected due to its weight. And then how can you do event analysis? See, this whole idea of because you are basically trying to concentrate on firm specific news in the question that you've asked. You are trying to understand, suppose if Reliance is impacted by some negative news flow, and because Reliance has a lot of weight in the index composition, so typically this news flow would also reflect in the index performance. But if we go by the structure of how an event study can be executed, or the event study design per se, this normal return generating model, the whole idea is to isolate the firm specific performance. That means that component of the price movement which is typically occurring because of the market wide fluctuations, because some part of the movement also will be dictated by the markets at large or in general. So if that whole process, the market model basically isolates the part of the price movement which is because of the market, and price movement which is typically because of firm specific factors. So coming back to your question, because the model itself solves that issue where we are able to isolate the performance or the price movement that we observe on a given day, like what part of it was because of the market wide fluctuations and what part of it was because of maybe firm specific factors, or typically what concerns the company only, is done by the model itself. So if we follow the market model, or if we adopt the approach followed in the market model, typically we can execute reliable event studies. Am I able to answer your question, Mr. Chaturvedi? Okay, thank you. Did you apply sentiment analysis to even the negative positive news? The answer to this question is yes, but sentiment analysis, I don't know how do you actually relate to this, because there is one session being lined up which is sentiment analysis. Not in relation to that particular session sentiment analysis was done, because as I said, the idea is in an event study we have to take into account the sentiment of the news flows. Now when you do sentiment analysis, obviously like one can employ machine learning where you have a bag of words and you use that kind of coding to kind of using algorithms to kind of classify your sentiment. That typically, can be associated with, use of or classification of sentiment based on computational linguistic methods using machine learning techniques. But for the purpose of this study, as was the approach adopted in Pritamani and Singhal, the paper which was published in Journal of Banking and Finance, they advised that a simple approach of, classifying a news into sentiment based on sentiment is to go by the, event day price reaction. So if the news is good, so markets will obviously react in a positive way. Let market be the judge. If the price reaction is positive, we can conclude the sentiment of the news is positive. And if the price reaction is negative, we can understand or we can conclude that the price reaction is negative. That was the approach suggested by Pritamani and Singhal. So, that is the whole point. So we can adopt this approach and continue to do event studies and come up with reliable inferences based on these event studies. So thank you all for all the patient listening. And first of all, I must also take the opportunity of thanking Ranjit sir for giving me this opportunity to be part of this prestigious event, because I have seen myself that this event has grown in both stature and reach over the last 5 years, almost half a decade. And I hope this event will continue in the future also and continue to benefit young researchers like us, because the foundations of behavioral finance, I must say, was learned in the workshops that you have undertaken. And obviously, I have known you for almost a decade before I came into academics. So I had the privilege of knowing you for that length of time, and you have always continued to be a source of motivation and inspiration for me on a personal level. And I must say this endeavor or kind of initiative in the form of this workshop that you have adopted will continue to benefit young researchers across the country and across the globe, because this is representation or participation from across the globe, and kind of further inspire researchers to take up issues pertinent in the context of behavioral finance. So thank you so much, sir, for this opportunity, and I hope I have been able to do justice to the expectations you had when you gave this responsibility of taking up this session in this particular workshop.
Thank you.
Thank you, sir.
Thank you, Nayanjyoti, Dr. Nayanjyoti Bhattacharjee, and this was really a very useful session. We are conducting this workshop, but this is the first time we are conducting a session on event study to quantitatively measure underreaction and overreaction in the market. So thank you for giving your time, and it seems from your presentation and the slides that you have given enough times and with dedicated time to prepare this talk. So thank you very much for accepting our invitation and giving your time.
One particular mention that I'd like to make is, this the second part of the discussion was typically related or closely related with the price dimension of the reaction. The aspects or the key issues related to the volume dimension was somehow not covered, because I understood that the time would not allow it. So,
anyway,
perhaps
the whole idea of this workshop is to just to instigate the idea about this event study, or just instigate the just idea is enough, inspiration is enough, and once the people are motivated, then they will find some way to
figure out,
do their calculations and studies anyhow. And your information is already available with them, and if anyone is having any kind of future collaboration or any kind of research, but definitely they will be contacting you. Yes, this is, just please note down his email ID, nayanjyotibhattacharjee@gmail.com. So that will help.
my full name @gmail.com.
Yeah.
And my research is available at the ORCID ID.
That's great. So thank you, Nayan, and thank you
so much,
participants for the patience listening, and we shall be back at 2 o'clock to have a discussion on social network analysis, another dimension of very important tool nowadays used in behavioral finance research. Not only behavioral finance, in any kind of research, we are using it in behavioral finance. Tool is a tool. It's up to us to use it, whether for the behavioral finance or marketing or HR or OBE or operations anyway. So thank you. We shall be back on the same link at 2 o'clock. Thank you, Nayan.
Thank you all. Have a great day and great learning in this rest of the workshop that is planned for the next couple of days. Thank you all.